My name is Michael Guyette, publisher of the Lead Lag Report. Joining me there is Len Kiefer, who's got a little bit of knowledge when it comes to mortgage rates, housing, given what he does for his career. So, Len, for those who are not familiar with you, introduce yourself. Who are you? What's your background? What have you done throughout your career? And what are you doing currently?
Yeah, hey, great to be here, joining you on this space. So yeah, my name's Len Kiefer. I'm a deputy chief economist at Freddie Mac. So I work on what we call our economic and housing research group under our chief economist, where we put together analysis around trends in the U.S. housing market, mortgage market, forecasts, scenarios, analyzing things, typical economist work. I've been there at Freddie for about, coming up on, this will be year number 14. I joined back in October of 2009, just a little bit under that milestone there. It's been an interesting time in the housing market. I came to Freddie. I had been a PhD. I'd studied. I was a very short-term professor at West Texas. And then I came over to the DC area and joined on in Freddie pretty much, a year out of grad school. And been working there, ever since. It's been quite interesting times. Lots going on in the housing market. A lot of analysis, a lot of interesting work to do.
All right, so let's get into it specifically as it relates to mortgage rates. I always emphasize that it's not the level that kills you; it's the speed that kills you. Lay out what's been happening just maybe the last several weeks here. I mean, there's been a pretty aggressive sell-off in 10-year treasuries. Obviously, that impacts 30-year mortgage rates. Mortgage rates, look like they're spiking. Do you get a sense that the speed will now really be quite disruptive or problematic, or do you think the housing market can still absorb what's happening?
It's a challenge. I mean, especially the last, couple of weeks when rates, the 10-year has surged a bit, and that's passing through to mortgage rates. You mentioned the tweet I had, or the X post I had, Ice Age. We're actually back now a couple of years earlier in terms of where rates are. We're like the early 2000s, the highest rates we've seen, in more than 20 years. And as you alluded, that speed of adjustment has been quite a challenge, especially over the last couple of weeks as, the Treasury's pushing to new highs. That's passing through to mortgage rates. We've seen that absolutely in home sales, which have come off and are going to struggle, I think, to really rebound with these higher rates, especially if the outlook is potential further increases. It's a lot of uncertainty. We don't know, but certainly the near-term trajectory is up. We're in the kind of slow season for transactions for the most part because we're getting into the fall here. So you sort of have a seasonal slowdown. But absolutely, these higher rates and the speed of increase are a major challenge. One of the dominant stories, not the only one, but one of the dominant stories for what's we should expect to see in the housing market.
Has it been surprising you to see how this is all unfolded? I mean, there's a lot of things I think that would suggest that there's nothing really in the history books that shows kind of where we're at now cycle-wise.
Yeah, it's really hard, right? You have to go back ages ago, back a couple generations, to really the late 1970s to see a world where interest rates have increased. In fact, but even that, interest rates went up a lot in the late 70s, early 80s as we were battling inflation then, but they were coming off a really high base. We've never experienced this situation where rates were not quite zero, but under 3% for a 30-year fixed, and then more than double in a year, and are now, close to 3x, not quite that, but, up quite a lot in just a short period. That speed of increase is absolutely unprecedented, certainly in modern U.S. history, perhaps internationally, but then it's hard to really translate. So in terms of somebody like me, who's like a data person, I like to do a lot of empirical analysis, try to model this. It's really challenging because we haven't had an environment like this in the housing market. Certainly, going back 40 years. And even then, if we look at some dimensions, it's unprecedented. So very challenging market to try to figure out. We do our best, try to look at things, but it's tough.
So one of the counter arguments you often hear is, especially from older generation is, I paid 7-8% on my mortgage rate. So can a younger generation? And obviously there's a lot of context around that, but let's talk about sort of the ability of consumers to absorb that. I get the sense there's a lot of people that are new home buyers that are under the impression that they can always refinance later. But the reality is the starting place of debt, I think, makes it problematic even to just wait that long. If give the audience a little bit of context as far as what's different from mortgage rate levels now versus when they were back at these kind of levels in the past.
Yeah, I do want to think it's really important to note that when mortgages are underwritten in today's environment, folks may be hoping that rates will fall, but they're not underwritten in that way, which is different from how it was, back in the mid 2000s. So I just want to emphasize that when folks are looking at credit decisions, it's based on where the rates are. Right. Some folks may be hoping that rates will fall, and certainly look at market futures that had been some of the expectations, but that's not a guarantee. Right. But with the level of where rates are, it's a challenge, right? It has priced out millions of potential buyers from the marketplace, where how rates have moved higher over the last couple of years. Now, the issue though is there are millions more with the capacity, even though it's very expensive, right, to move higher, and prices now going back up. So affordability is very low. There are still enough potential buyers out there, particularly in those first-time buyers who don't have an existing mortgage. They're not enjoying a low rate. They're looking at rents going up and, deciding that maybe now is the time, makes sense for them from, where they are in their life, they're buying. And so we have a lot of first-time buyers coming into the market, and they have the capacity. Now, as rates continue to push higher, we're over, 7.25% rate. Potentially could get up, 7.5%. Once, they get to that kind of level, you're going to price out a lot. And so we'll have to see how the market holds up over the next few months.
But presumably that capacity is a function of unemployment not rising in a substantial way, right? I mean, I think that's kind of the correct me if I'm wrong on this, but I'm going to make the assumption that those that are forecasting, maybe you as well, that housing remains buoyant into next year. There's a joint hypothesis there that's also around employment.
Oh, that's absolutely. I mean, we're enjoying an unemployment rate that is very low, right? Under 4%. That is the underpinning for this, right? A strong labor market. You're starting to see a little bit of real income increases to help offset some of these inflation pressures that have eaten into household budgets. That's absolutely. If unemployment were to go up sharply, that would really change the outlook for the housing market. Our baseline view is that we get a moderation in the economy, but not a big spike. And in that world, which is close to a lot of the other consensus views on the housing market, you get slowdown. Transaction volume certainly will be a lot lower, but much different than if we saw a big spike in the unemployment rate. Then demand would really pull back, and you'd expect to see a very different housing market.
All right, so let's get into your broader views in terms of forecasting housing broadly for next year, with the caveat that, again, it's always localized until it's systemic. Right. So let's talk about just kind of baseline. Where do you think things are going? And maybe just touch on what are some of the variables that people need to focus on when it comes to trying to understand where housing goes next.
Yeah. So I think there's kind of two components I want to separate out. If you think about on the transaction side, right, new flows with a lot of folks that are, if they're real estate agents, loan officers, certainly that's what they are focused on. If you're thinking about that kind of aspect of the market, it's been a tough year in 2023, and looking ahead to 2024, probably going to be equally, if not tougher, for a couple of reasons. One is the higher mortgage rates. Another is that households in 2023 still had a pretty substantial buffer of extra savings they had built up during the pandemic, right? A lot of assistance programs, other things went to U.S. households. Some estimates over $2 trillion of excess savings for American households. That really helped support demand in the face of higher prices and higher interest rates. That savings has largely been spent down. So going into 2024 and with rates where they are now, look like it's going to be a challenging environment from a transaction flow standpoint. So the declines in home sales may stop, right? So home sales may stop falling, but they're probably not going to pick up a lot until we see, the rate outlook stabilize, and if the economy, remains on a solid footing. So it's probably going to be a pretty tough year from a transaction standpoint about the number of mortgages that get originated, the number of home sales transactions. So that's going to be a tough year, probably, not going to see some real optimism to the end of maybe next year if we have a good, baseline economic scenario. For the performance, though, if you think about folks that are holding credit, performance has been really good. Unemployment rate's low. Households have a lot of equity. Home prices have actually started to increase again. Again, it's very localized, depends on where you're looking, but nationally, house price growth is picking back up because of the supply and demand imbalance. And that probably will continue, though we'll have to see. The rates have spiked up a bit for the past few weeks. That's probably going to cool things a bit on, say, home price front. But so we'll have to see. So you kind of have this two-sided picture. On the transaction front, very tough years, lean years probably for the next year out for sure, probably in a baseline view. And then for the performance, price, credit, they'll probably hold up pretty well. Again, assuming we have a slowdown or only modest uptick in unemployment going forward.
Are there nuances even within those? So, they said that there's more cash-only transactions for higher price types of housing. Do you see a distinction between that and those which are more likely to be mortgage because it's more on the lower end? I'm going to assume that there's some interesting sort of disparities going on at the extremes.
Yeah, I mean, so the key, I think that we go back to mortgage rates. We got to think about how this is an unprecedented situation for the U.S. economy, right? Rates got down to 2.6 in our survey, record low, 50 plus year low, just a couple years ago, right? Millions of homeowners refinanced, huge refinance volumes in 2020, 2021. So they locked in for 30 years in most cases, those low mortgage rates. Those borrowers are not in the market to refinance. They're not in the market to move likely unless something happens, with life situation or job opportunity. So those borrowers are on the sidelines and likely going to stay there, right? Over time, that effect will wane, but in the near term, in 2023 and likely much of 2024, those borrowers are sort of out. And even a modest downtick in rates isn't going to matter, right? There is something like 60% of mortgages have a 4% or less rate. So even with a pretty big decline in rates, 1-2 percentage points, they're still going to be out of the money and still going to face, have a lock-in effect where they're just staying out of the market. So that is likely, that's nothing we've seen before. We did some analysis, Freddie, just trying to look back and say, okay, this lock-in is so substantial. How does that compare to history? And so we did some analysis. We looked at our portfolio loans. We calculated sort of what's the present value of those low mortgage that those homeowners have locked in for conventional mortgages. It's about $55,000 in value that the homeowners have locked in as long as they hold onto their mortgage, right? And so that's a big incentive. And in fact, when we look back in the early 1980s, when they had a similar type of increase in rates, the lock-in effect was not nearly as big then because rates were going from 10% it got up to 18, but it wasn't quite going from 2 to 7. So we've got sort of a very challenged environment in terms of that, and that's going to drive the market, not forever, but in the next 18 months, it's going to be a major story.
So I've floated this idea out. Something that I personally believe in. I think there's a interesting argument around this idea that, okay, so you've got the lock-in effect, but at the same time, as that being fairly unprecedented, given where we are now, what also is unprecedented and not really in the data is, you had this Airbnb type of dynamic, right, over the last decade or so, resulting in a lot of people turning, because of low rates, buying second, third homes and making them into income producing properties, people that are landlords, some professional, some not. And that then maybe complicates it so that, sure, there may be a lock-in on your primary residence, but at the margin, the second and third homes, which also have that low lock-in, well, if they're not getting, rental income, well, now they might be in trouble. Doesn't matter how cheap the locked-in rate is. Is there some degree of truth to the idea that, this kind of inventory shortage you often hear about, maybe at the margin gets solved by, just unloading some of these Airbnb type of properties?
I mean, that economists, so everything will have an effect, but I don't think it's first order in terms of the dominant driver. We've looked a lot at sort of where the housing supply situation is, and these second short-term rentals are a factor in the marketplace, but the dominant factor is that we have not recovered home building in the United States since 2008. And so since we've had more than a decade and a half of below replacement level home building, we have just a massive shortfall of housing across the board given where our population is. And so that has created a pressure in the marketplace, and why these first-time buyers are coming in to a marketplace where there's just not that much available for sale, and even the bid prices up, right? There's still not pulling much more inventory into the marketplace. So you mentioned these investors may want to try to sell, right? But there's just not enough of them in aggregate compared to the pressure coming from the millennial generation. Now, that's not going to last forever, right? That population bump is only for a couple of years, but it is a couple of years. If you look at sort of the average age or the median age for millennials, it's still in their late 20s. Some of them are 40s. The millennials are a big group, but they're still pushing through. The bulk of that population is still coming through sort of peak first-time buyer years. And so that is putting more pressure on a market that's already massively short of the aggregate number of housing. Now, again, it's going to matter locally because some places have excess of housing. So, but you smooth it out over the whole country. There's just, in my view, not enough housing to meet that longer run demand. And that's why we're seeing, even with interest rates, over 7%, house prices starting to pick back up again.
How long would it take so you mentioned a couple of years on the demand front, but is there a risk that the there's maybe an overshoot of supply. So you go from shortage to abundance to a glut, just, because of the underestimation of maybe how demand could fall off aggressively if mortgage rates stay elevated relative to, home builders that are planning more and more building.
If you look at the history of real estate, that is the cycle, right? So that is always a potential issue because, right, you think about the investment decision is going to build a home. That takes, a year, 9 months maybe for a single family home, although with supply chain disruptions and labor maybe take a little bit longer, right? But you got to plan that ahead. And certainly there is a risk that the cycle sort of gets out in front. Now, currently, the demographic shortfall is such that it's hard to, even with the uptick in building, over, since 2008, that's been a grind to get up. So I don't think we're in imminent danger, at least in aggregate. But this, again, real estate is very local. So you've got to look, particularly if you're thinking about subnational trends, particular markets, there things can be a little bit different. So, but at least on an aggregate national view, I don't think we're at risk of that. Again, if the employment situation holds up, if employment slips, right, that'll really change at least the short-term dynamics there. But it's really more probably 3 to 5 years out where you really run into that potential, where you get building ramping up over the next 3 to 5 years, and then demographics start to have a shortfall. So there things get a little more interesting. But at least in the near term, I don't think we're at imminent danger of that type of dynamic.
I'm going to speak here also looking at credit conditions and seeing what the banks themselves are doing, right? And the more that we see this carnage in the pristine asset being quotes safe collateral, the bigger that mismatch is between the banks and their liabilities. I mean, sort of a regional bank dynamic from March at a much bigger scale, which then obviously causes a pullback of all lending, I would think. Talk about the state of bank lending here and how that could maybe complicate both arguments, the bull case and the bear case for housing.
Yeah, there's no doubt that there is some pressure on some of the banking sector, particularly some of the smaller institutions there, and so they're facing depending on their portfolios, if they're exposed to commercial real estate, they definitely can have potential challenges there. Although the big macro aggregate story seems to be we stabilized things in the spring, given where things were after Silicon Valley and the other banks there. But if you take it to the mortgage standpoint, mortgage markets function very well. Now, I market Freddie Mac. We're on the secondary market. We help provide liquidity in that marketplace and help keep things going. So at least in terms of on a credit side, although, some banks may be pulling back on how much they're holding on their balance sheet, there's still credit availability is generally pretty good for consumers that are qualified to come out into the market today. And now things, we'll see how things evolve. But at least in the near term, that credit availability is probably on the margins, maybe tightening a little bit, depending on how banks feel about what they're holding in their portfolio. But overall, for borrowers that can find a home, like that's probably number one challenge, right? Can you find a home? If they're qualified, they're able to get credit in general.
You mentioned the international side briefly a little bit earlier. I don't know how closely you track international markets. Obviously, mortgage dynamics are very different. Like, for example, Canada. But I get a lot of people that talk about that being sort of a tremendous crisis to come because these mortgage rates in Canada tend to reset into higher rates. How vulnerable is U.S. housing mortgage rate dynamics? How vulnerable is that to just other international respective mortgage housing dynamics? Is it one of those things where what happens in Canada could have weird consequences on the U.S. when it comes to their housing market?
Everything that happens in the world, right, especially the U.S. is based on global capital markets, right? It has some effect. It becomes hard to tease out exactly. Canada by itself is not large enough, probably be drive things sort of in aggregate in most scenarios. I mean, something to watch for and think about. It could have more effect on some of the local markets, maybe that are closer to the border there. But in an aggregate story, probably of not a first order impact there. I do think it's interesting to contrast the United States to most other countries because we have the fixed rate mortgage. Right? Most other countries have maybe fixed for a couple of years, not 30 years. And so that fact that American consumers were able to lock in low interest rates over the last couple of years has had a big impact on the macroeconomy. Part of the reason why some of this financial tightening hasn't dented consumer spending as much as it has in past is because of the prevalence of fixed mortgages. If you go back to 2005 and 6, right, something around the order of 4 out of 10 mortgages had adjustable rates. that were being originated then. And so the share of debt outstanding that was impacted by short-term, or interest rate increases was much, much larger. Whereas today, with the vast majority of mortgages being fixed term, most of them fixed 30, the sort of impact from, say, Federal Reserve tightening to financial market conditions tightening to higher interest rates hasn't hit the consumer balance sheet as quickly as it would. And so you think about the transmission mechanism for monetary policy to the real economy has been slowed a bit because of that. And so that's helped the consumer hold up because they haven't seen their mortgage payments go up. Now, non-mortgage interest expenses have gone up tremendously. If you look at on a year-over-year basis, non-mortgage interest payments for U.S. households are up about 50% from a year ago. So that's starting to bite. And that will likely lead to, in that baseline scenario, a slowdown in consumer spending and a slower economy. So that will translate. If we had variable rate mortgages and households were seeing their mortgage payment go up, that's one of their biggest, expenses on a monthly basis, the real economy would have reacted much differently. And I think that's an important dynamic and something to consider, to think about when you think about the long and variable lags in monetary policy. Well, part of the reason they are more variable and longer perhaps than they were in the past cycles is because of the mortgage market.
I wonder if that makes the kind of go forward forecast trickier, not to make it sound like it's more dangerous, but if more of it's going to, variable rates which keep rising, revolving credit in terms of just the spending power and where income is put to work, as opposed to the fixed side, I got to imagine that makes it hard for consumers to budget properly because they don't know if the minimum payment's going to be the same next month or, on their credit card, for example, versus, much higher months later. Right. So I would think that creates a whole degree of volatility that's hard to model.
Yeah. I remember years ago, I had dinner with a guy, Australian, and Australian has mostly variable rate markets, and Australian economy is exposed more to commodity price, right? So their currency even fluctuates. They have extra volatility there. And they're saying, like when, their mortgage reset every year, they'd have to redo their family budget, right? They'd say, oh, well, rates are up a lot more than we expected. We'll have to pull when it won't be able to go out as much. We'll have to cut back on, our groceries and, maybe our vacation gets shortened a little this year. So that definitely creates, a dynamic and effect on consumers. And now they're seeing sort of the effect of inflation. They're seeing they're not, credit card, auto, other debt, start to rise. That's absolutely going to affect consumer behavior. And in our baseline view, you have growth is somewhere around 2% this year, goes to 1%. That doesn't sound like a lot. Like, oh, the economy is going from 2% growth to 1% growth. It's still growing. Yeah, that's better from from shrinking, but that's still pretty painful when you're talking about an economy as large as the United States. So I want to minimize, even though our baseline view has no recession in it, it's still going to be a tough economy, and the unemployment rate will tick up. You probably see, a million more people lose jobs from where they are today. So that's a tough economy. It's not going to feel great. Feel better than a recession will, but we're seeing that's sort of that dynamic that's playing out in the economy, as we speak.
I had a question from the audience posted saying, if demographics are an important factor in demand, what are the implications of boomers downsizing versus millennials forming families?
That's an incredibly fascinating question and something we've looked at because, what's really tough is, right, we have what they call economists called censoring, right? We don't know sort of, what the life expectancy of boomers is relative to prior generations, right? Because they're, still with us, right? But over time, if you look at historic cohorts, right, as people get into their 70s, certainly their 80s, it becomes very difficult to maintain a single family home in particular, but even apartments, right? And you see people age out as a cohort of the housing market and sort of give you that demographic shortfall. But if you look at the more recent generations, they've living longer and healthier lives. And so the effect of that is to delay, right? I think eventually they will age out of housing like prior generations. It's just maybe 10 years later. We don't know exactly because we haven't, gotten to the end yet. But that gives us another sort of logjam in the housing market because prior generations, those older cohorts would have been aging out of the housing stock and freeing up a pretty significant portion of the housing supply. Something on the order of 1 to 2 million housing units a year are being held off the market because the boomers are living those longer, healthier lives and staying in homes. Eventually, that will come into the marketplace, and that's hard to project with certainty, but probably is going to hit in the later parts of this decade or even the early parts of the 2030s. Hard to believe that we're talking about 2030s, but hey, we're already in 2023. So, but it's crucially important and something that we're definitely looking at because that's a big swing potentially.
I don't know, man. The more markets get volatile, the more stress levels go up, and the more the average age level of the boomers living is probably going to drop over time. Let me just reset the room, and then I'll go for a question. Anybody wants to come up and ask questions, click that bottom left mic request button. Happy to bring you up. As always, this will be a podcast under Lead Lag Live on all of your favorite platforms. And please, folks, feel free to engage and share this as we're live for the remaining minutes.
Yeah, so of all kinds, because it's not a precise estimate, right? There's a lot of different ingredients that go into that, which create a lot of uncertainty around the precise number. We've published a couple of studies, and we're actually in the process right now of updating a study we published. I think the last one was in 2021. And so we're trying to incorporate post-pandemic data estimates. So we look at a variety of factors. So you think about it, there's kind of two components, right? There's the supply and demand. And so when we think about the supply, that's straightforward, at least from a conceptual point of view. We look at the number of housing units that are available. And when we do this analysis, we look at not just single family homes, but also apartments, manufactured housing, all kinds of housing that's available. And there are estimates published by Census for the United States. That gives us the supply, straightforward, at least conceptually. Got measurement issues. Demand is a lot trickier because you have to figure out, well, what would be the kind of long run housing demand for the United States in some kind of benchmark economy, and how do we think about that? So we've done a lot of studies trying to look at demographics, look at the age profile, education, income, other demographic features of the U.S. population, and think if these population tracks historic averages, how much housing demand would that generate? So, for example, you look at sort of the 28-year-old, modal, 29-year-old sort of, modal millennial, how much housing would they consume, like on average, right? And so we come up with an estimate of that and look at what their actual headship rates are, which is still quite a bit below, prior generations, and project that forward. And then finally, you need to have some sense about what should be the vacancy rate. And this comes back to the question about Airbnb and other, short-term rentals. Like how is housing used? Because not all housing is occupied full time. And so we have to come up with an estimate of what is the second home share, what is the sort of naturally vacant housing, and then what is the sort of, frictional vacant housing, which has to do with sort of short-term dynamics in the market, what's available for sale and for rent. So there's a lot of assumptions that go into that. We've documented them all on a paper on our FreddieMac.com website. We're working on it. So there's a lot of uncertainty, but that's how we try to build that up. We try to be transparent about the calculations. You got a pretty wide confidence interval on it, but I do think it's pretty confident that you can say, using kind of reasonable assumptions in that estimate, you get some kind of shortage. How big exactly it is going to vary, but I think under any kind of reasonable parameters, at least right now, in the US, you get a pretty sizable shortage in the order of, over 1 million housing units. Our estimate was closer to 4. So I work for Freddie. Freddie's a giant organization. I don't look at that particular part for Freddie's portfolio, so I can't speak for that. There are folks who look at that. I look more generally at the macro economy, sort of the investor position in the market. That's an important dynamic driving there. Investor share has been holding pretty steady for the overall marketplace, not, abnormally high, not too low. So that's something we look at. But in terms of the specifics on my company, that's not something that I look at or that I could speak to. I'll bring it back to the issue of shortage, right? So when we're looking at it, we're thinking about it both the owned market and the rental market, because I think you have to combine the two. You can't talk about just the owned market. There also is the rental market. So when I talk about a shortage, I'm saying all housing, not regardless of the tenure, right? Do you own it? Do you rent it? Regardless of the structure type, there's just, if you count up the number of people and you say, what would be where's their demand at on a long-term, view, and you look at the amount of available housing, the only way that you can sort of match that is you drive vacancy rates too low, and vacancy rates are not going to be zero. There's also, there's a structural component of the United States because a lot of housing that's actually available is in places where job opportunities are not very strong. So there are places with very high vacancy rates, but unfortunately the labor market there is very weak and people are generally moving away from those places. You go to the places where demand is the strongest, there's not a lot of housing available. People are doubling up, tripling up, shared living arrangement, commuting really long distances. That's the dynamic that we see there.
Let's talk outside of housing for a bit, Len, because a lot of things impact housing, obviously. But are there other interesting sort of metrics or things that you're noting from a broader economic perspective that are worth paying attention to? I mean, it looks like we're in the uninverting part of a yield curve movement. And yeah, typically when that happens, that's right as a recession's about to kick in. That maybe it's going to be different, or maybe it's a false signal, but it is at least historically something to pay attention to. What are some of the things that you're seeing economically outside of housing that are worth discussing?
Yeah, well, I want to mention something that's proximate to housing that matters a lot for housing, but goes beyond housing because they're related here, which is how people have dealt with their work situation following the pandemic, right? I mean, this is a massive macroeconomic story. We had big rise in remote work during the pandemic. Some of that has stuck, some of that's being rolled back, but it's a massive story in the sense that it has, allowed people to move around the country, move to places that are maybe more affordable. Certainly, if you're comparing sort of what a typical, a tech worker could get in the Bay Area versus what they could get in Idaho or Phoenix or, Western markets, it's just a lot more affordable for them. And so that driving dynamic sort of has impacted the housing market, right? And we see that in the price, but it has bigger impacts on just the overall economy, how people's careers and income life cycle goes. There's a lot of really interesting questions related to that. And, we're still early stages to see how this all plays out, but there's going to be this enormous cohort effect. How has it affected, people just starting off their careers? I think that's a fascinating question. It of course matters for the housing market a lot, but also matters just for the general economy, life cycle earnings, and society even. I'd say that's one of the major areas. And there are dimensions of this that are, longer term, right? Are people able to move to areas where there's, greater economic opportunity, where upward mobility may be higher, where there's more integration between, higher and lower income families, which actually can possibly create, opportunities that would not be present if you were more, segregated. There's a lot of really interesting research going on around that topic, something that, we've been looking at, thinking about more narrowly around the housing market, how people are relocating, but it's just going to be, I think, potential, massive story and could affect, long run growth rates for the economy. And so that's sort of an area that we're thinking about. But if you bring it back to the more economy on the yield curve, I mean, it's hard to ignore a signal like the yield curve, which has been successful when so few other indicators are. But the past couple of years have been so abnormal. I alluded to the tremendous amount of excess savings that households had built up and the potential shift to long and variable lags of monetary policy. It's very challenging to know, and we won't know in real time sort of where we are. Are things fundamentally different? Probably not. But are there exceptions that prove the rule given the unusual circumstances of the last couple of years? That's something we ponder and think about. We don't have the answers, but it's something that we are trying to keep our eyes on as most folks that are tracking the economy.
Okay, going back to mortgage rates and then housing more broadly. Historically, when you look at these cycles on mortgage rates, again, with the caveat that we've never seen anything like we've seen speed-wise here, how long does it typically take to see mortgage rates kind of start to not just level off, but then really turn down in a meaningful way? I mean, presumably it's not going to be an immediate shift. There's going to be some duration to whenever we actually see, maybe at some point, lower mortgage rates on average.
Yeah, I think there's something that's useful to point out here that folks who aren't, steeped in fixed income may not think about as much, but matters a lot for the mortgage rate. A lot of folks look at the 30-year fixed rate mortgage in the U.S. and compare it to like a U.S. Treasury, which over long history makes a lot of sense and is a very reasonable thing to do. And they note, and I've had this question many times, well, the spread on that has widened a lot, which means the mortgage rate's gone up a lot more than the Treasury has. And why are mortgage rates so elevated? Well, a lot of that has to do with the dynamics of prepayment and, the technicals there. Bottom line is, as long as there's a lot of volatility in the interest rate environment, that pushes mortgage rates up even more. And so even if we are in a higher for longer environment with rates, and everybody knows that, and they don't anticipate rates to come back down, that decline in volatility would create some certainty and would contribute to a decline in the mortgage rate. Right now, with so much uncertainty around the marketplace and a lot of volatility in treasuries, that spread has gotten elevated. So even if we're in a world where rates, in general, in the economy stay pretty high, you could see mortgage rates, come back down pretty. It's hard to say exactly where they would land, but you look at the spread now is elevated of somewhere around a percentage point from historic norms. So that could give you some buffer for mortgage rates to ease. Not sure they'd go down all that much, but that would give you a forecast, even absent a big economic shock, right? If we had a big economic shock, a recession, rates would fall a lot. But even if you don't have that, you could see a world where mortgage rates gradually ease, get down to the, 7, 6.5 range, even with, elevated 10-year yields. That will give you some relief. And because rates won't be going up in that world, that may give you some modest uptick in transaction. That's why I said it's still likely going to be a tough year if you're in a transaction space. If you're looking at new loan originations, new real estate transactions, it's probably not going to feel really good in 2024. Might start to feel better at the end of the year, but likely once we get through that, 2025, not that far away. Seems like it is, but then things might tick up again because in that year, if rates have stabilized, and then you've got, the still positive demographic forces in that, 2023 to 2026 time window could shape up to be a better year. You kind of have to hold on, probably get through another tough year in 2024.
Right. And actually, when I hear you say that, I mean, not to go back to that prior question, but if the idea is that more volatility creates higher yields, right? It's like it's a feedback loop, right? That's going on in the bond market. So, which again, I would argue means, you need some kind of exogenous factor to stop that feedback loop. And that's usually the Federal Reserve. So it's interesting to hear that. That makes sense to me, right? The more volatility there is in rates, the higher rates go, which creates more volatility, which creates more higher rates and dislocation.
Well, no, this is more specific to the mortgages, right? So you don't necessarily need an exogenous force. Of course, those always matter because of the prepayment risk, right? If you're a mortgage bond investor and you're not sure what the rate outlook goes, you say, well, maybe we're at 6% or 5.5% next year. That's going to mean a lot of refinances, right? And that could lead to losses there. So they have to factor that in when they are testing their appetite for holding mortgage bonds. So that's not the same. I mean, there could be the self-fulfilling aspect, but it's really more around the technical, around the mortgage market. So in that case, all you need is, you don't need a shock. You just need certainty. In fact, less shocks, right? So if we could get, if consensus views come in, the market outlooks have shifted a lot this year, right? As, this year has unfolded, inflation data's held up and been higher than, what some may have hoped at the beginning of the year. It's been stubborn. It may be coming back down. That uncertainty is what's contributed to that. So even without any new shocks, just sort of a coalescing of views, that would kind of naturally reduce some of that prepay risk and lead to lower mortgage rates for consumers. Those are great points, and I have my comments on them. So let me unpack them one at a time. So yes, so one of the key differences between how we look at it and the way you described it is you're looking at sort of the overall population. And sort of embedded in that is sort of assumption is that all the people, sort of each person, right, has the same kind of implicit housing demand. But one of the key differences is the age profile of the population. You go back to 2008, right? I'm a Gen Xer. That was kind of Gen X was in their peak home buying years, right? We're still at our peak. It's a long extended peak. But just look at the population there, right? The millennials were all, kids. They were, very young. They didn't create much direct housing demand in terms of household formation, right? They may have expanded sort of the space needs of those families, right? But it's just in terms of the number of units, they weren't utilizing the same, you'd have 2 or 3 kids in a family, that shrinks that ratio, right? Or adjusts that ratio. I usually think of it as households over population, so I might get the signs reversed. Right? So what we look at is try to look at the age profile and then account for the fact, as I mentioned, that there are many millions, right, of those 70 million millennials. They're coming through the housing market and they're at 28, 29, 30. Those are sort of the bulk of that population. That's when home demand and rental demand has really started maximizing, right? And so that is why that's the little difference between the math, and we could have a chat, maybe connect. I think we may have chatted off and on here on that comment. Certainly I've had comments on X about that, but that's the distinction there is you got to factor in the age profile. And when you do, that gives you different utilization. And also someone else had a comment, right, about the older population holding on. That also changes sort of the space, sort of how much housing is needed. So you put all those things together, that's what drives some of that arithmetic difference there. Now, longer term, right, as we get past Gen or the millennials into Gen Z, the population starts to fall off. And then that sort of calculus becomes unfavorable. So that's what I mentioned, the sort of late 2020s, early 2030s, that story can change. But at least in the near term, we've got a tremendous housing demand. You don't have to just look at those numbers, which are useful. You just can look at the vacancy rates, or you can look at the rate at which homes sell, still very fast, right? Vacancy rates are very low. Homes are selling very fast. Those are indicative of very strong demand given sort of the supply situation. Yeah, so I don't think we actually disagree much on this. It's just the way we structure this. So our view is really a longer term, is a longer term kind of through the cycle approach, not explicitly not factoring in short term affordability. But it is thinking longer term, sort of where the income may be. But you're right. In the short term, hey, we have high interest rates, we have high prices, and that's one way that you sort of govern the sort of excess. If you have a lot of demand relative to the available supply, that bids the price up. And so that's part of the reason why house prices have outstripped income, is because you have all these people competing. They're at the age, but they all can't make it happen, right? Because there's not enough housing. And so how do you ration that? Well, through the market, it gets rationed through price, and prices move higher. Right? So that's absolutely the dynamic at play there. Our view is just saying, in absence, it's stylized, but saying, well, what if prices relative to income were normalized to some benchmark? We use the year 2000 in our analysis. Then what would you see? But it's not a prediction, right? Like near term, it's sort of an idealized longer term situation. So absolutely in the short term, or even, next couple of years, high levels of demand relative to the available supply keeps pressure on prices and keeps them elevated relative to income as you're trying to ration what little supply is available. One of the stats we have to try to look at sort of what's happening on the single family side is just sort of how fast homes are moving in marketplaces. It's in recent months, even with this elevated, interest rates, you're still seeing homes move very fast relative to historic averages. And again, that's a sign to me that the demand at least is there for what available supply there is.
And I think it's a good place to wrap up. Len, for those who want to track more of your work and get some more of your thoughts, where would you point them to?
Well, you can follow me here on X. I'm at Len Kiefer. I'm also active on LinkedIn, connect with me there. And if you're interested in some of the research and stuff, you can follow, I work for Freddie Mac at freddiemac.com/research. You can find a lot of the studies and analysis that we've posted there. But if you want help getting connected, they can, link to me, and I'll put them in, give them the links.
Appreciate everybody to join today. I'm going to have a few more spaces this week, and hopefully the world is not going to be over by Friday, given what's going on with treasuries. Thank you, everybody. Thank you, Len. Appreciate it.
Yep. Thanks.